Season has begun. What are the possible outcomes we can see from this election, and what will be the impact on the Indian markets? UBS has come out with a note on this where they've looked at three possible scenarios and what their impact could be as far as investors are concerned. Tanvi Gupta Jain, India economist at UBS, joining us now to speak more on this. Tanvi, great to have you back on NDTV Profit. Superb to be speaking with you today on the note. Now, you've looked at three possible scenarios. In scenario one, the BJP is the single largest party, has a majority on its own. Scenario two, it's in a coalition. And scenario three, the India alliance comes to power. Do you have a take on what is most likely and how markets would react to each?
Okay, thank you. So before I start, let me start with my disclaimer that at UBS, we do not predict the election outcome. And we do know that opinion poll, exit poll have been wrong in the past. That said, we did try to look at the various election scenarios possible, which we just highlighted, talking about BJP single largest party, BJP-led coalition, and the third option is a weak coalition led by India Alliance. I would say, as of now, based on whatever opinion polls are available, they are hinting that Prime Minister Modi remains the most popular leader in India. In fact, even if I look at the recent performance in assembly elections, it also showed that the Modi factor or the perception of work done and even the implementation of the welfare schemes were in favor of the BJP government. So at this point, most of the opinion polls are pointing to political continuity. Our discussion with investors at the same time, looking at the valuations right now in the market, I think the first two scenarios seems to be already priced in.
In your scenarios, you also talk about if the BJP comes back as single largest party with a clear majority, which it also had in 2019. An alliance is running the government, but the BJP has a majority on its own. Then the positive private Capex cycle will begin. That's, one outcome. Possibly. What I was wondering, Tanvi, is that the conditions in that case for the positive private Capex cycle to begin already exist from the last 10 years. Why have we not seen it then, in that case, if the factor was a full majority of the BJP? And then what changes if they come back?
All right. Very, very valid question. So if you look at the underlying drivers for a Capex cycle recovery have now turned positive in terms of asset quality of the banks, which I think in the last so many years, we did see a lot of cleaning up of the bank's book happening. And finally, we are seeing a double-digit buoyant credit growth, even though it is more biased towards consumption. And I really hope that we start seeing corporates, the larger corporates, start asking for credit because in the hope that there will be a private corporate Capex revival. And second is, even if I look at the balance sheet of the corporates, I think a lot of corporates deleveraged their balance sheet over the course of the pandemic. And now, for the first time in a decade, they are in a much better position to add more or take on more debt to expand capacity. The third driver of the private corporate Capex cycle, which is, I would say, is much anticipated, we are yet to see it in a big way, is that if I look at the funding, taken up by the banks, by the corporates or I would say the RBI has started releasing that data in terms of funding secured for Capex. And that is also showing a very sharp pickup, especially in the first half of FY24. We only have the data available from April to September. And the last data point is the capacity utilization levels. We have seen that capacity utilization levels have picked up from the low of 60 to almost close to 76 right now. If I look at going back in data or going back in history, normally when capacity utilization levels are around 78, 81, we do see companies or the corporate sector beginning to expand capacity. So when I say political continuity, it actually bodes well for business sentiment. And we really hope that the much anticipated private corporate Capex recovery actually picks up post-election. So that is something which we are estimating. In fact, I would say in those scenarios, I would even expect further progress on supply side reforms, whether it is in terms of clean energy transition or high infrastructure spending, not only soft infrastructure spending or digitalization, but also a lot of focus on physical infrastructure spending, a larger manufacturing push. And at the same time, what the BJP government has kind of highlighted in the budget, targeted policy initiatives, whether it is youth, poor, women, and farmers. So I would say you need an overhaul of many things to work for the overall broad-based recovery in private corporate capex that we hope to see at some point in time.
That's what I was curious about as I was going through your report, Tanvi, that what's on the list left to be done? Because if you look at the entire, and of course this happens pre-poll, if you look at the entire campaign, it is that all the promises made have been fulfilled. That we're already on that growth trajectory. A lot of the reforms have already come into place. And I'm wondering what remains that would be key to the markets and, in the hope of not just this positive private capex cycle, but going to the next level.
Absolutely. So what we did was we actually looked at what could be the impact on different reforms and the various government scenarios, depending upon the three scenarios we talked about. And we looked at some 8 to 10 parameters, whether it's fiscal discipline, whether it's infrastructure, whether it is further digitalization push, divestment, FDI, PLI. Including, something like a land acquisition bill or a uniform civil code. So I think what more can happen definitely are three things. One, a big push towards physical infrastructure, which India is still needing, as per our estimate, while a significant digitalization push has actually helped in improving productivity and efficiency levels. We still need a massive push towards physical infrastructure spending. Maybe taking it towards 7 to 8% of GDP on a more sustainable basis for India to move to a higher growth path. So that is the first part. Second is PLI. We are already seeing the government has expanded the PLI. They have identified 14 sectors. There is an incentive scheme in place, but definitely we need much more further boost in terms of other easing of regulations in trying to boost the manufacturing push towards India. Third is a land acquisition bill. I think maybe another attempt could be possible. So I would say even in the rural economy, maybe there could be more focus on structural reform. So definitely there are a lot of possibilities where we do see that to help India move towards a higher growth path, there could be more policy push needed at this point in time, largely on the supply side reforms.
Tanvi, just the thing around what a policy continuity could mean for FDI, and because India's share of FDI has fallen quite considerably in the recent past, one of the thoughts is, and I would love to understand how you think about it, one of the thoughts is that because commitments are being made into futuristic sectors wherein the pace of investment will become large with the next 2-3 years. So you will actually start seeing the material physical flows only in maybe 25, 26. Would you, if there is policy continuity assuming, would you believe that to be the case?
Okay, so the way we do it is we looked at FDI in sectors, and what we realized is that if India was getting FDI inflow of $60 billion, we are right now tracking FDI around $45 billion. When you look at the net FDI number and you say, wow, FDI has actually halved, that is largely because a lot of repatriation of FDI outflows has happened in the last couple of years. So I won't completely, yes, partly I would agree that it is the newer sectors where, we would expect FDI to pick up. In fact, if you look at UNCTAD survey, they are saying India is one of the few countries or the top 5 countries where the greenfield investment intentions are very high. And if you plot that according to the FDI inflow chart, you do see that they do tend to move in tandem. There is some lead and lag. But at this point, even we are hopeful that the FDI inflow will pick up. But I would say at this point, we are still getting $45 billion of FDI. If I look at manufacturing FDI, which is the most important metric to track, to look at how big the meaningfully the supply chain shift to India are happening, that number used to be $8 billion a decade back. Today, it is somewhere between $14 to $15 billion. So in that sense, yes, there is a significant improvement. But yes, for FDI to really pick up, we definitely need much more massive manufacturing push in the country. So the hope is in the next 3 to 5 years, FDI flows start to pick up. But at this point, I think it is more because of the weak global capital markets, private equity deals not really happening, and that does flow into your FDI inflow number. And the third is a massive also repatriation of FDI outside the country.
Okay. Tanvi, net, just trying to think out, 5 years out, do you believe the numbers will look stratospherically different? I know we are out of time, so just take one quick question. Do you think the numbers will look stratospherically different than what they are looking right now?
Absolutely. I mean, if I'm very confident that India is on a 7% GDP growth track in terms of higher potential growth, the FDI number which you are seeing right now, roughly around $45 billion, would definitely be in the range of 75 to 90 billion or dollars in the next 5 years.
Great. Okay. Tanvi, so good having you. Thank you so much. Would have loved to talk more, but I understand we have to let you go. But thanks for taking the time out and being with us today.